There's two main ways to limit risk during earnings season. The first is to trade options instead of trading the stock. And when you're trading the option, you want to treat the entire premium as your risk. So the worst that can happen with an option is it goes to zero. A stock isn't going to go to zero, and you wouldn't buy a stock thinking that it would go to zero. But with an option, you're treating the premium as your risk, and you would also be thinking of what happens if the stock moves in my direction. Let's say it has a 10%, 15, 20% move after earnings, and it does it within a couple of weeks, potentially even a couple of days. Then the price of your option could go up 3, 4, 5 times very easily. And you could use the premium, right, the amount that you paid for the option, as your risk, so that way you can still participate in the move and limit your downside. That's one of the best ways to use options. And so if your stock is reporting earnings in the next week and it's starting to break out, you can play it with options and treat that premium as your risk and limit your downside. Second way to limit your risk during earnings season is to adjust your position size. So let's say you're interested in a certain stock. Let's say you're interested in Microsoft, and you think that it is going to have this monster run. It just had this big consolidation, and you want to play the breakout. Fantastic. So what you could do is buy the stock, but then look at where is support. If you're looking at a price chart, if you're looking at, say, a daily chart or even a weekly chart, where is support? Where's the 10-week line? Where's the bottom of the base? Right now, Microsoft is in a cup-shaped base. Where's the bottom of that base? If it gaps down against you, how far could it fall? If it falls to the bottom of the base, how far is that from wherever price happens to be right now? If it breaks below there, where could it go? And then from that, then you want to start thinking, well, is it worth the risk? Is it worth it to play with this much smaller position size? Maybe it is. Maybe you say that it's not. Maybe you're the type of trader that wants to have a toe in the water. So you're like, you know what? Even though I'm going to have a third of the position size that I would normally have, I'm going to take this trade. Okay, great. If you're somebody that's not, you're like, you know what, that's not worth it for me, then fantastic. You could wait until after earnings and then have other ways to get into a trade post earnings if it starts to run without you. A great way to get in after an event, like an earnings event, is to have a way to get in if it gaps up. If you're a swing trader, the way that I like to do it is to wait until the end of the trading day, right? Like, so you had this big gap up move, and if it's closing near the high of the gap, right? To not enter yet, but that's telling you that it gapped up and it was bought all day. Fantastic. Now what you want to do is wait until the next day, and if it moves above the high of the gap, then that's your entry point, right? You've got this fresh move. You had this whole move up on high volume. You're getting in right there. And then if you do enter, place your stop loss right below the low of the gap. Stocks tend to move in the direction where the gap starts. So trade in that direction. It's already proven that it's had a lot of strength. It had this big breakaway gap move. That's how you could enter and limit your risk, and already have the confirmation that there's a ton of buying demand behind it. And there you go. 3 ways, not just 2 ways, to limit risk around earnings.